I recently took a position in UnitedHealthcare stock. The ticker is UNH, and I'm recording this mostly for myself to keep a record of what I'm buying, why I'm buying it, and what I think happens from here. Markets tend to get caught up in the headlines and the fear, and I don't really care about that in the short term. What I'm looking at is where the business ends up once all the noise fades, and where the numbers, the margins, and the earnings per share trend once things normalize. So here we can see the revenue has almost doubled in the last 4 years, from around $257 billion in 2020 to $422 billion now. But earnings per share, we can see, hasn't followed. If I look at the trailing 12-month earnings per share, it's about $23 a share. And guidance for this year is $16.50, which is basically flat with where they were 4 to 5 years ago in 2020. So revenues are way up. Profits haven't moved. To me, they could be a temporary spread issue, not a structural one that we'll see for the next 2 to 3 years. Because costs rose faster than pricing, and once premiums reset, margins should recover pretty quickly. The top line is already there. It's just a matter of pricing potentially catching up. And that's what makes the setup so interesting, is once margins start to come back, even just a little, the earnings impact can be big. You're coming off such a low profit base that a small move in the margins, even 1 or 2%, could mean a double-digit jump in earnings per share without the company really having to grow much more on the top line. So the key driver here and in this industry is the medical loss ratio, which is basically the percentage of premiums UnitedHealth pays out in claims each year. Historically, they run around 83%, but this year it jumped to 89.4%, which is the highest that they've ever reported. That 6-point swing alone means they paid about $27 billion more in claims than they usually do in a given year. To put that into perspective, that's nearly double what they earned in all of 2024. So they have roughly 900 million shares outstanding. So even if only half of that dropped to the bottom line, that's around $15 a share in lost earnings for the year. Even at their current P of roughly $15, that alone can move the stock $200 to $300 higher. So with the current stock hit this year, it is clear that there's plenty to worry about, whether it's policy changes, higher utilization, or lawsuit exposure. But when I step back, I think it's important to separate what's temporary from what's structural. Most healthcare stocks took a hit this year, but I think UNH offers the best risk-reward setup in the industry. They have the strongest balance sheet with the most cash on hand. They have major insider buying from executives to people in Congress and value investors like Warren Buffett and Michael Burry. And they're best positioned to hold market share while also expanding their ecosystem. What most insiders understand, what I think the market is missing, is that UnitedHealth isn't just an insurance company. They've built a second engine with Optum, which is the pharmacy, the data, and the care delivery side. And this subsidiary lightens the hit when medical costs jump. Smaller players don't have that kind of buffer, and that's what gives UNH a moat that's tough to replicate and continues to allow them to maintain market share. What I also like about UNH is they don't have a history of manipulating the numbers. Even looking back at prior years' financials and accounting, the company has a history of honest and conservative accounting and reporting. This past year, they didn't pull from reserves to boost the earnings per share, which a lot of insurers tend to do. They're paying claims on time, they're holding a lot of cash, and so even though earnings are down, the quality still looks clean. They're generating around $25 billion a year in cash, which they're using it to buy back shares and to keep building out Optum. And they're using a little bit of it to pay out dividends, which typically isn't my favorite move in public stocks that I invest in, but with their size and the maturity, it makes sense for them. All of that gives them breathing room to invest, to shrink share count, and to lean in opportunity while the stock is still relatively cheap. So that's what's happening right now. Longer term, it comes down to where the medical loss ratio settles. And long term, both UNH and regulators tend to target an MLR of the 80 to 85% range. And for the most of the last 5 years, they've stayed within that range. My guess is this year's jump to 89% is probably temporary. So they have mentioned that the way they plan to fix the high medical loss ratio is with higher premiums. And analysts expect premium hikes of 15 to 20% in the next cycle. And because insurance pricing resets on a lag, it typically takes time for those new rates to flow through. The pain we're seeing now should ease as those higher premiums hit in next year's numbers. Another point that's optimistic for UNH is 78% of their 2026 plans are 4 stars or higher, which is up from 75% in 2025. And that is meaningful because investors were worried about people would downgrade their coverage with the rising premiums. But we are seeing that that's not happening. People are sticking with higher quality plans, which lines up with management's comments that the business mix looks stable and it looks high quality. And that does matter because those higher rated plans actually get bonus payments from Medicare. So the better their scores, the more revenue they pull in. And it also makes those plans easier to sell since seniors see the star ratings when they shop. Now on the pricing side, and this is extremely high level overview, historically UnitedHealth trades around 23 times earnings. Now, right now, the stock's pulled back and is trading around a 15 PE. And if earnings per share recovers to around the $22 to $23 range, that should put the share price somewhere between $475 per share and $525 per share. Now, my base case is around $500 per share by early next year, and maybe higher if the returning CEO moves quicker to get the margins back in line. They tend to be conservative with their guidance, and their operating cash flow consistently runs ahead of their earnings, which at this level, you're basically getting one of the strongest cash machines in the market at a trailing PE that's almost half of the S&P 500's. Right now, I'm up around 17% on the position, and my plan is to hold through next year and maybe longer if it takes more time for the thesis to play out. I normally don't buy healthcare stocks, but I think the setup here is good with limited downside and solid upside once the earnings reset.